Okay, so apologies for that. So if you decide to do your fixed interest capital to equity capital, okay, there is no reason for you to do it. Okay, if you know the other one, there's no reason for you to do it. Okay, but just so you have it in case maybe you are asked specifically to work this out in part A, perhaps. So it's the exact same top line. Okay, so your debentures plus your preference shares divided by your ordinary, this time it's your equity capital, which I've told you already is your ordinary shares issued plus your reserves. So it's 450 and 79. Where does that come from? So firstly, it's your ordinary shares issued, which is 450,000. Your reserves is just the balance on your profit and loss account, which is there. Also, obviously, is at the end of your profit and loss account. Okay. So when you put those together, so 200 plus 150 gives you 350,000, divided by 450 plus 79 gives you 529, multiplied by 100 gives you 66.16257,089, rounded to 2 decimal places is 66.16%. I would actually prefer with this ratio not to multiply it by 100 and put it like you would put your acid test ratio to the ratio of 1. Okay, so what you're saying there at 0.66 to 1. So what you're saying is that for every €1 of equity capital you have, so for every €1 of ordinary share and reserve, that you've got 66 cent of equity capital. So basically, this is a bit confusing, but with your acid test ratio, you were looking for 1.1 or higher. With your fixed interest capital to equity capital ratio, you're looking for anything under 1 to 1. Okay, that means it's lowly geared. Okay, again, with this one, as you know, anything under 50% is lowly geared, and that is what you're looking for. Okay, now a company could survive on more than that. Okay, but that's the objective, is to get it under 50%. Okay, and the lower the better. Okay, because the lower the gearing ratio is, the less you're reliant on banks and loans, etc. Okay, particularly like in the current climate, if your business goes out, your company goes out of business and you've had to close your doors, as many have, then you're not worried about the banks, even though for the COVID-19, they're sort of giving them a bit of leeway on their loan repayments. But at least it's not a headache if less than 40%, like in this case, is coming from debt. Okay. The last one is your interest cover, which again, if you have done this question, you will already have this answer. So it's your profit before interest and tax divided by the interest for the year. So your profit before interest and tax, as I said, forget about, also known as your operating profit, by the way, but don't worry about the word before, because people think before to think subtract. Okay, remember, your profit before you paid interest on your loan and before you paid any tax to the government will have been higher than after it. Okay, so your profit before interest and tax, you'll have to add the interest and tax. Now, fortunately, there is no tax to worry about, but we do have interest. Okay, so you can see there, your net profit was €114,000, and the line above it, your interest of 16. Okay, so you take your net profit, that's your net profit after interest and tax, and add the interest back to find what it was beforehand. Okay, so 114,000 plus 16,000 divided by the interest of that 16,000 again gives you 130,000 divided by 16, which comes out on the calculator as 8.125. So when you leave it as 2 decimal places, again, if you want to go a step further and put it to a whole number, you can, but make sure you show it to 2 decimal places before that. So 8.13 times, that compares favorably with last year, which was 6 times. Okay, so basically you are able to pay your interest 8.13 times out of your net profit. Okay, and that's good. And the higher that figure is, the better. Whereas with these two gearing ratios, the lower the better. But I know I've put it in the middle, which makes it look more prominent. But the one in the middle is the one I would actually leave out. So when you're doing gearing, do the gearing ratio, which is fixed interest capital to total capital, the first one you see in your book, and the interest cover. Okay. What I'm going to do now, I'm going to pause. I'm going to stop this video. And the next thing I'm going to do is I'm going to revise the figures, which a lot of people don't do, is revise the figures to include the €300,000 loan and see how those figures change when we add in 300,000. Okay. And I'll talk to you then.